A credit card company underwriter from a top US bank gave 10 years worth of advice and insights into how a large credit card issuer approves and denies applications and how they hand out credit limits. This is your chance to finally find out why your applications keep getting denied and what the bank is truly thinking when they see you pop up in their system. You'll learn why having no debt and a 0% credit card usage makes you a worse borrower to the banks, why your FICO score alone is useless with some major banks, and the one credit card that gives the most starting limits over $20,000. So let's talk about the interview. I really couldn't believe how open and honest the underwriter was with their answers, really giving us a peek behind the curtain at some of the bank's best kept secrets. So the first question is, FICO score metrics junkie here. We get lots of questions about becoming an authorized user on a parent or spouse's established account. We know how it affects FICO scores, but I'm curious, how much stock does the underwriter give to this? For example, 18-year-old with no credit history becomes an authorized user on an established account and now has a 700 FICO, but it's not really his history or score. How much would having an authorized user trait line on an otherwise young, thin, or non-existent file improve the odds of approval with the underwriter, assuming it's not just an auto-approved or denied situation by the algorithm? And the underwriter said, these are regarded as a thin file, and those FICO scores are not comparable to thick files, say a 700 score. Usually there are thresholds on the number of trades and length of history. 5 trades in 24 months history is the minimum to move you to the thick file and open up all options. Nevertheless, you will find some offers in thin files. A lot of those are testing or small segments that banks believe might work, but card offers are usually limited there. For instance, Capital One does offer some options to thin files, so from that sense, it does open up some options. So here's what I think. One thing that's not mentioned here is the underwriter is really a computer algorithm 80+% of the time. You know, in an older interview with an underwriter from a top 5 bank, they said around 80% of applications are decided by software. They also said for applications that are reviewed manually, 75% of the time when we underwrite manually, the decision is clear and there's almost no subjectivity. For the rest, there could be some subjectivity. I'd say maybe only 5% are truly on the fence applications. So we really have to be clear, there is no single human underwriter who will painstakingly review your application. Your application is immediately reviewed in milliseconds by a soulless robot to decide if you get approved or not. And another thing is that the very same underwriter from a previous interview said, we're not a FICO lender and don't go by their scores. FICO factors in things we don't care about. For example, when looking at your credit report, we're not allowed to consider medical collections and utility collections. We feel these types of derogatory information, which lowers your FICO score, are unreliable. And they also said the vast majority of the time, the credit report is the only tool used to make a decision, and most of it's done by software. So what you have to understand is every lender has a different approach to approvals. Most likely use a mix of a FICO score, your credit report, and their own internal scoring to come to a decision. But you could come across banks like the one I just mentioned that never even consider your FICO score altogether. And the next question was, when you say trades, you mean accounts, right? Like mortgages, loans, credit cards, etc. And they said, yes, accounts. And I don't want to assume anything about you. Just so you know, a trade line is a record of activity for any type of credit extended to a borrower and reported to a credit reporting agency. The next question was, are they looking for 24 months of having 5 trades or 24 months of history of any kind plus 5 current trades, which may only be a month old? The underwriter said 24 months of history of any kind and 5 trades of any kind. Now, I'd say banks and the FICO scoring company like to see recent activity usage on your accounts to determine credit worthiness. You know, a previous underwriter said, even if your cards are 15 years old, if you've barely used them, it does us no good when we evaluate your credit worthiness. Sure, it proves you don't need credit, but it doesn't show how you manage credit. And they also said the way you manage and repay that loan is what allows banks to evaluate your credit worthiness. And in a separate interview that I covered, a FICO scoring company manager even said the data shows that having 0% utilization is slightly riskier than having a low utilization like 2%. Having low utilization is an indication that you have credit and are using it responsibly. That same manager also said the FICO score measures how well you manage your debt. If you don't have any debt, The algorithm doesn't have any data about how well you manage your debt. Think of it like being a fast runner. You may be a very fast runner, but if you've never run any races, it would be hard for anyone else to know how fast of a runner you are. And listen, this might shock you, but this means that if you have 20 high limit credit cards that you never use and recently paid off your car loan, you're in a worse borrowing position than someone who actively uses their credit. So just remember that. And then the next question is, how much weight do you really give to inquiries? And what sort of patterns raise red flags? For example, if you see 5 inquiries over 2 days versus 5 inquiries over 2 weeks versus inquiries over 2 months, how would you handle those on an otherwise clean report? Or what if you saw a pattern of 1 to 3 inquiries per month for 4 months? And what sort of timeline would you like to see credit activity cool before you'd be comfortable considering extending credit? And the underwriter said, the way decisioning works is that there are some strict cuts, and then there are bureau variables that are in the decisioning model. Most models are now quite complex, so it really depends on what model the bank picked and which attribute they picked. But an inquiry attribute is always negatively correlated, but no bank in my experience sees inquiries beyond 2 years. There may also be strict cuts in number of inquiries too. Ideally, the banks don't want to run your application through a decision model if it doesn't meet those strict cuts. So you can manage those cases, there is no balancing act. Unless your inquiry count goes below the threshold, you aren't getting approved. And I gotta tell you, I can't stress this enough. Every bank is different, and even the same banks can change their lending criteria from season to season. That's probably the reason why the underwriter never gave a hard number of inquiries to stay below. Also, the FICO scoring model only includes inquiries from the past 12 months, but banks can see and judge you based on inquiries you made up to 24 months ago. And another underwriter that I covered before said FICO might not think they're a big deal, but we will if it's excessive. And the FICO scoring model reduces the impact of hard inquiries the older they get, and their impact is reduced to 0 after just 12 months. Bank underwriters have a completely different policy though. For us, hard inquiries are hard inquiries. It'll be considered the same whether it was pulled last week or 4 months ago. And I can't stand hard inquiries. You know the worst part though? You can still get a hard inquiry even when you get denied for a credit card. Some credit card companies like Capital One will do you real dirty too and hard pull all 3 credit bureaus. But you know what? That's why I like a few of these new business cards like the Bill Divvy card, because you can get fully approved without a hard credit pull whatsoever. So you don't have to worry about hurting your credit score at all, and it never reports your usage to the personal credit bureaus. They only report to the Small Business Financial Exchange to help you build your business credit scores. They even give you automatic credit limit approvals up to $400,000 without going through a manual review, and you don't need to submit W-2s or tax returns. You can get up to 7x points on dining transactions, and a year ago, they approved my new LLC with a $2,000 limit. So just click the link below to apply for the Divvy card and get approved without a hard credit pull whatsoever. And the next question is there hard cutoffs for minimum income for being approved for cards? Or does it just determine credit limit? And the underwriter said, largely only for credit limit. I mean, I don't think any banks verify your income in the online application. Some are thinking about it, but don't see this happening soon. And I'd say this is partially true. All the large banks never verify your income when you first apply, but many of the credit unions will ask for pay stubs or W-2s. Income just doesn't matter when it comes to most applications from the top banks though. And you know what? The previous underwriter said, I think many people will be surprised how little time we spend on someone's application, whether it's underwritten by software or manually. There's no time to do income checks, especially when income plays an extremely small part in the approval process. And they also said, we know stated income is usually exaggerated, but your credit report can suggest whether your stated income is believable. Whether we believe it might influence our underwriting decision. For example, if you claim to make $250K per year, but just took out a tiny auto loan for $14K over a 7-year term, that'll make us question your stated income. Now here's the next question. This is interesting to me. I'm curious what banks think when they see someone like me with an 810 FICO, 790 Vantage, $100,000 plus cumulative credit line, less than 5% utilization, no derogatory marks, $300K in reported income, and then 6 hard inquiries and 6 new accounts in the last 2 months. I'm guessing it screams churner. I just got approved for my 6th card in 2 to 3 months. A US bank Altitude Go after a review of my app, so I'm curious what they thought when they reviewed it. And here's what the underwriter said. They said most often there isn't an actual person looking at your file. It's all based on models and predetermined cuts. They aren't making a decision based on just one person, but a cohort of persons. So while one of you may be a gamer or a churner, there are some good people in your cohort that are going to make up for the loss on you. And two, for prime customers and those with excellent and good credit, banks look at the total value. They might make a loss on a credit card, but get a bigger pie selling you a mortgage or etc. That's why relationships matter with prime users. And three, even if you are prime, if you have a lot of inquiries, they will reject you. Also, there are different cuts for different types of cards. For instance, you may be disqualified for one card, but approved for another card because the bank thinks they will make more money out of you from that card. And four, as for review, there may be a fraud or know your customer concern. They are usually the two that trigger manual reviews. Now, I think you got to understand that banks are playing the long game with multiple pieces. They may take a loss on a credit card and make up for it with another product. And the previous underwriter said, one time during our monthly floor meetings, a VP said something interesting. He said our most profitable accounts are those that are slightly above subprime. Although we're not a FICO lender, that'd be the equivalent of a FICO in the low to mid 600s. He said these folks tend to revolve balances, pay lots of interest, pay fees including the annual fee, and also buy subscriptions such as credit monitoring. So the bank might be willing to take a short loss on you just to push more people into services like credit monitoring. And it's well known that some cards are considered premium and only for people with excellent credit, like the Capital One Venture X card. But it's really lesser known that banks are smart enough to steer you towards different cards based on your unique profile and expected profit. Now, let's move on to the next question. They said, what cards do you see that have the more generous credit limits on average? And what is the biggest credit limit you've seen on a card? And what was the card? So here's what the underwriter said. Premium cards in general have higher limits. Chase and Amex come to mind. The Capital One Venture X isn't bad either since it's offered for higher tiers, but their limits on other cards won't be that high. I operated more in the sub 700 FICO ranges, so those limits are not that generous. Personally, I have the highest limit at $45,000 on my Bank of America card. Other cards are around $30,000. But I have been approved by Amex for a purchase up to $80,000 too. I checked with their spending power tool. Now, I'm glad they use the Venture X card as an example because it gives some of the highest starting limits in the game. You know, when I analyzed over 100 credit limit data points, I found the Venture X gave people the most starting limits, over $20,000. And my limit with my Venture X is sitting at $26,000 right now. Now, the next question is, how much does underwriting factor into whether you have a checking account with the bank? Here's what the underwriter said. It matters in thin files, and it might help if you go in person to the bank. Otherwise, not so much. Now, I want you to just know all banks can operate differently, especially here. This is likely true for a fair amount of large banks, but local community banks and credit unions absolutely make decisions based on your relationship with them. That means they want to see how many of their products that you're using, how many deposits that you're making, and how long you've been a member with them. Listen, I personally spoke to a representative with NIH Credit Union on the business credit side, and they told me it's not necessary to have an account with them to get approved, but it definitely helps. And speaking of credit unions, if you want to see 7 different credit unions that will pre-qualify you for credit cards with just a soft credit pull, then check out the credit union section of my credit card pre-approval master list. I'll leave a link to that below so you can get instant access. And some of those credit unions even show your starting limit too. And that really comes in handy. So going right into the next question, they said, depends though. I have a thick file and was denied for an ink card with one reason listed as having no business checking relationship with them. My wife was the same, except she had no checking or savings relationship. For reference, I already have 4 Chase credit cards and a past closed Chase checking account. So they know I'm a reliable customer. So Chase seems to care sometimes, even on the thick files. And they answer by saying, true, business cards value those. And I'd say, opening a checking account and depositing at least a few $1,000s, then depositing more money on a regular basis over, let's say, a 90-day period is just so powerful for building a relationship with a bank that you're looking to get future business funding from. And there's actually 4 banks that have recently shown they have a large appetite for lending to new LLCs. Plus, they all come with 0% interest business cards for up to 12 months. Definitely hit the next video right here to see the success stories from other small business owners and to see how to run a $200,000 funding play for your business. Thank you for watching.